This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Thank you for joining us. I'm Gord Long. It's my pleasure to have with me this morning Charles Hugh Smith, well-known and prolific writer on the web and the publisher of the well-recognized website of2minds.com, and also a longtime co-host with me here at Macro Analytics. Welcome, Charles.
Thank you, Gordon. Always a pleasure.
And how long before you head back to Hawaii?
About a week.
I know. No snow on the ground in New England, so I'm quite pleased. Charles, let's jump right into this because we always seem to run out of time. And what I wanted to do today was to kind of follow up on our cycles discussion that we had the last time we had our session before your last trip to Hawaii, and because what we're seeing is, I think, is a major rotation, and it's not about Donald Trump and what he's doing. I think it's much bigger than that, and that is a rotation from monetary policy to fiscal policy, and what's driving it and what's under it. And I have up here the agenda of the kind of the sequence that I'd like to go through, but we tend to wander from the agenda. But at least let's see if we can keep it on course that way. But we to start this off, we had this austerity push after the 2008 financial crisis, specifically in more so in Europe than anywhere, where there was this attempt to try and get the crisis under control. There was some stimulus, no question about it, but then trying to focus on austerity, all governments got turned over. So there's been no push really on fiscal stimulus. It's all been monetary. And I can remember even in 2012, Chuck Schumer, who was at the time was not leader of the minority, but a member of the Senate, saying in Humphrey Hawkins' testimony by Ben Bernanke that he was the only game in town, the Federal Reserve. In other words, public policy, fiscal policy, there was too much gridlock in Congress, at least in the United States, and it wasn't happening. And we've been in that right up until now, and I think it's finally starting to change. Comments on that?
Well, Gordon, I think that's an excellent introduction to our topic, which is how these long-term cycles impact government policy, monetary policy, and social trends. And that's really where we come to the point where all the policies that were implemented after 2008, the global financial crisis, they've run out of steam. There's diminishing returns. They didn't work. In other words, lowering interest rates, did that fix everything that's broken? No, growth has been stagnant, right? Has austerity, like kind of tightening the belt of government to try to leave more money to pay down debt, that didn't work either, at least in Southern Europe. So everything that's been tried has failed, and that's why they're going to have to rotate to fiscal stimulus, because monetary policy has failed. Wealth inequality is rising, not diminishing, right? And growth is stagnant at best, or even in decline. So they're going to have to try something else, and there's not much left in the playbook except fiscal stimulus.
And here we go around the cycle again, because we proved before that there's some major concerns with fiscal stimulus. But in this case, what's different this time is the multiplier effect on fiscal stimulus isn't what it used to be. 20 years ago, it was 3 or 4 times for what dollar that was spent in fiscal stimulus, we get growth in GDP, and it fell. And matter of fact, it was getting close to zero or quite small before 2008. And we were all talking about the major concern as it fell off, but we weren't really pumping a lot of fiscal stimulus at that point in time. Well, I just read a lot of good research papers, and Lacey Hunt down in Austin, Texas, probably one of the finest bond traders in the world, is quite emphatic on this. and his research too, is that number is now quite negative on any fiscal stimulus. And so any of this fiscal stimulus, it will create some jobs if they're well targeted, infrastructure, but then infrastructure is not like the 1930s where we hire a lot of people. There's some. It's all automation. It's all heavy equipment. There's more capital that goes into it really than labor. There are some jobs. But the fiscal stimulus factor just isn't there because we're more about innovation now and creation. And we're not going to, that fiscal stimulus isn't putting more factories in place. So it's going to have to, it will work if it's extremely well targeted, is question. What does work, interestingly enough, a little sidetrack, is tax reductions are still have a significant multiplier effect. As long as you got enough taxes to offset the interest rate on the debt that you're carrying. But it's quite positive. So, but I don't think people are, we're hoping. So unless it's well targeted, there's still going to be a problem there.
Right. And Gordon, I would add 2 points to you. What you just said was, one is when our infrastructure was really poor, that investment paid off huge returns. Like, for instance, the construction of the national freeway, highway system in the late 50s, early 60s. Back before then, Highway 66 was a 2-lane road for 1,000 miles. Well, obviously, you can't do a lot of truck traffic on a 2-lane road. So we got an immense productivity increase from that infrastructure investment. But now we're simply repairing what we already have. So we're not really creating any new productivity tools. We're simply repairing what we have. So once the jobs are done, once you've rebuilt a bridge or strengthened the bridge, then the stimulus goes away. So it's a completely different order of stimulus. The other thing that we are going to talk about is, how do you pay for infrastructure stimulus? You have to borrow a lot more money. You sell a lot more sovereign bonds. Well, now the debt cycle seems to have been reversing. Interest rates have hit bottom. Now they're rising, which means the taxpayers are going to be on the hook for higher interest payments going forward. And that acts like a governor on how much you can borrow. You can't just keep borrowing tens of trillions of dollars, because the cost of that borrowing is starting to go up.
Yeah, precisely. Just your comment about replacement infrastructure, it's not increasing productivity, though it's starting to hurt productivity because we haven't been investing. And I do agree with investing in infrastructure. I'm just not sure it's going to get, or I'm actually quite negative, it'll get the gains we expect. It needs to be done. Unfortunately, as you point out, there's a debt that goes with it. If you want the delta in productivity, then it should be things like free Wi-Fi across the country. Anywhere you go, government-supported Wi-Fi, you don't pay. It's ubiquitous. Then productivity starts to go up because people can use it. There's a gain there. That's the new forms of infrastructure. We can go on with what that is, but we don't. We seem to be going back as though it's 1930 and we're going to have more picks and shovels. And it needs to happen because it's completely broken. But another point on this too, Charles, why this austerity and stagnation is happening. And I did a paper here on the crisis of trust. And what happens with when people stop trusting the system, they start trusting what politicians are saying, they start questioning, which we clearly have in spades, and we've seen this in a number of elections. In actual fact, that actually, if you look at it, leads to stagnation. The cynicism that starts to come into the system, the lack of willingness to invest and take risk. And that's as big a problem as we have. And that's why what we're seeing, this, as Trump called it, this movement. If the movement wasn't about Donald Trump, the movement he was witnessing is a frustration in the middle class, the flyover America, of lack of opportunities, lack of, and we can all kind of guess at that, but it stems from this breakdown of trust. And we see anti-establishment, we see anti-EU, we see anti-globalization. There's no end of these major concerns, and they can be expected because we're seeing it's about the cycles, and we talked about last time. This was to be expected, and as you can see in our cycles, they're all heading down, no matter what the frequency, and no matter whether I'm only showing a few here, but we go to Kondratiev, they're all heading down, and they head down at different rates till about 2020. before they start to turn and head up. And they're all cycles based on different things: behavioral, economic, fiscal, ever mind different frequencies. Comments on that?
Well, Gordon, I think that the charts that you have on cycles are very compelling because you can see that they overlap on a variety of metrics. And in other words, we're not talking about just a financial cycle or even an economic cycle. We're talking about a political and social cycles that go with those. They're all connected, as we all know. So you have a slide here about Peter Turchin's work. And he's gone back and done a massive meta study of cycles. And he finds basically two kinds. One is integrative. When everything is improving, opportunities are expanding, then you've got integrative forces. People find reasons to work together on a common cause. But when things turn sour and you get stagnating wages, rising prices, opportunity is diminished, that's an age of discord and disintegration. So what we're describing is these disintegrative forces. And he identified three sort of causal sources of this discord. One is stagnating real wages, check mark. Overproduction of parasitic elites. In other words, elites who are skimming rentier income, but not producing any real goods or services, check. And deterioration in central state finances. In other words, governments are already over indebted, and now they're on this move to borrow even more. Check. So we've got three cyclical, long-term sources of discord.
Exactly. And wasn't writing this about modern times. He was studying all the cycles going all the way back, and what starts to arrive. And we're clearly at this point. What happens in my mind, Charles, at this stage, is the social contract breaks down. And what the social contract is the unwritten, undocumented understanding between the electorate and those who are elected, that their job is to give or allow and create an environment that allows everybody, no matter how hard they want, or if they're willing to work, that they can improve their family and their standard of living based on their efforts and their energies. The opportunity, if you would, is there. And when that opportunity is there, if they want, they can take it or they can try. No guarantees. They don't have guarantee. They just have, but it has to be felt that it's there. And we've had that in America. We've had it in a lot of countries. But the moment and you can have corruption, you can have bad government. People won't revolt if they can still have this opportunity. But the moment that is not there, that they don't feel that they can be better off. And I saw, Bernie Sanders, kids saying, the system's no longer working for me. The student loan debt that they're handling, having to work in donut shops, and they got a master's degree because there's no opportunity. That's when the social contract is not there. There's no opportunity even when they want to work. I remember listening to somebody in Spain, a person saying, I have a master's degree. I've done everything you told me to do, and I can't do anything with it. And they were angry. So that's when the contract starts to break down. And that's when, if there was corruption, crony capitalism, that becomes the lightning rod, because it's the fairness, the inequality. We've had inequality for a long time. It's worse than ever. We've had unfairness. It becomes the lightning rod of the objections. And so that's what's happening. And then you will get, if not revolution, you will get heavy rallies, anti this, anti that, which I think we're seeing. Does that pass your common sense test?
Absolutely. And I think what we're really talking about here, Gordon, is the causal connections between the social disintegration that you're describing, the fragmentation, the anger, the frustration, and in the changes in the financial and economic spheres, which, of course, follow the money. Everybody votes their pocketbook. These are the things that drive political change. And so you have a great chart here of globalization over 5 centuries. And we're finding an anger against globalization because people have awakened to the reality that it only worked for the top 5%. It actually was a negative factor for the bottom 95%. You're sure they're, the socks are cheaper at Walmart, but but then that doesn't replace all the lost income and that's been the result of globalization for much of the working class in the developed nations. So these what's worked for the top 5% hasn't worked for the bottom 95%, and people are awakening to that.
Yeah, so that's the anti-globalization feeling, is their standard of living and their ability to get ahead, that broken social contract. It just becomes another rallying point, lightning point. But you know, you made a really good point. Follow the money. And if you follow the money, what ties together is we've got these tectonic forces at play right now. And it gets back to, we're in the Kondratyov winter stage. And for those that studied the long wave, it's a approximately 55 year wave. It's generational. It's very much from what your grandmother knew and behaved, your parents, yourself, and your children. And in their whole feelings towards savings, towards austerity, work ethics, value systems will cyclically often change, and economies change around it. That one type of cycle. But one of the cornerstones of the Kondratyov winter, which I believe we're in, and anything statistically says that's where we should be, is when we start deleveraging. We have too much debt, and debt needs to be typically brought down. The last time we had it was the Great Depression, foreclosures, non-performing loans, people lost property. It's not a good time. And but it's part of this re-cleansing, resetting things, repricing that needs to happen. And and then that is what's happening, or trying to happen. But on the other hand, and I got a chart here that shows we're doing everything in our power, we, the powers to be, to stop that from happening, to defer a recession, for example. We don't even want to do that anymore. So by cheaper money to create demand, all we're doing, we call this kicking the can down the road. We're being successful. But look at all these programs that we're implementing, one after the other, which taken monetary malpractice to extremes. But if either we're going to have this deleveraging, which could be a tremendous depression, or we're going to see things, and I'll speculate, where the United States Federal Reserve will soon start buying the market, if they're not stock market, if they're not already doing it. We've got 12 central banks already buying it. Bank of Japan, Central Bank of Switzerland, Norwegian Bank, People's Bank of China, and I can go on. 80% say they're going to buy more stock next year. Will the Fed do that to shore up pension plans and everything else that could collapse? So, you know, that's what. So, which is going to break first? Are they going to fail and the system's going to collapse from this Minsky melt up, the potential, or is it going to be the debt just finally, the little collateral starts to collapse underneath the debt and can't change it? I don't know the answer to that, but I believe those are the tectonic forces underway right now.
Right, Gordon, and your chart is called Increasing Political Reactions. In other words, the political powers that be recognize that things are falling apart, that the solutions are no longer working or actually creating negative unintended consequences. So they're buying the asset classes that pension funds, insurance companies, and the wealthy own, stocks and bonds, right? So their game there is, if we keep buying it, it'll keep these markets lofting higher, and the illusion of prosperity will be perpetuated, right? That's the game we're in. That's the political response. So let's keep the markets lofting higher because it gives a sense that everything's better, even if 95% of the people aren't really feeling any of it because they don't own enough of those assets to benefit, right? Or they own those assets indirectly through their pension plan. So what the downside of this is, if the cycle is turned, and you and I are saying it has, then this debt is never going to be paid back in its current value. There's only a couple ways you can deal with a debt overhang. You can write it off and accept the pain transparently, right? Or you can depreciate or devalue your currency so that if your currency loses half its value, the person will get their money, but the purchasing power will have been reduced by 50%, right? It's kind of a stealth devaluation of your money. Or you get a market meltdown where the market collapses under its own weight, as you say, when the collateral can no longer support all the debt that's been piled on top of it.
$220 trillion or even higher now of debt it cannot be supported by the GDP that we have. And I've done another back of the envelope kinds of analysis. It's just too big. It's too crushing. I suspect as we wrap here, Charles, that it actually will be that we will print the money, that we will, because, for example, and buy markets, not just the bond market, potentially stock market and any other assets, because we have 75 million baby boomers retiring, 10,000 a day. The pension, we are $10 trillion underfunded in pensions right now. They cannot allow that to collapse. They are, so the best thing to do is to print it, to keep it up. So even though you will get the pension money, as you correctly point out, it won't buy anything or will buy a lot less. But people will kind of accept that without knowing what happened, other than what they're accepting is, I got my money. If they tell them you're not getting the money, and it'll be another problem. So what effectively is going on is we're dramatically reducing the standard of living. That's what's going on, without telling anybody. And it's not insidious, or it's survival. Because as we say, if that's not done, the collapse of the debt supercycle, which is so overextended, is so monstrous beyond anything we've ever imagined possible, 320% of GDP, it could be a depression that will be called the greatest depression and could go on for 20 or 30 years. And nobody wants that. So I don't think these are evil people doing evil things. I think they're just out of options, and we're trapped into bad policy decisions going back to when we took ourselves off the gold standard. When you move away from sound money, it always leads to this. Every country in history since the Romans started clipping coins have learned when you remove yourself from sound money, this occurs. So the question is for how long? Not to be, I think we're being terribly negative here, Charles, because there's a lot of money to be made until this happens.
Right. And the other thing is, if we allowed the bad debt to be written off, we'd have an 18-month recession that would be very deep, and then people would have trust in the system because they could trust that the assets that are for sale or the investments that are available at that time, the price is real. In other words, it can be trusted. It's set by the market. It's not been manipulated by some government agency. Because that's why trust is lost too, is we can't trust that the unemployment rate is meaningful anymore, that the interest rate reflects the market realities. And so if you can't trust the real value, then of course you're skittish or you don't make the investment. So actually the most positive thing would be to face this transparently. But that would cause two things to happen. The politicians would suffer and get kicked out of office because they would be having, quote, caused the depression, right? And then all the wealthy people who have gained an immense wealth, right? The corporations and the banks in this asset bubble, they would lose, say 75 to 80 to 90% of that wealth. So they're the ones who are paying the politicians tens of millions of dollars in campaign contributions to keep the bubble inflated to protect their wealth, right? And the bottom 95%, if there was a huge write down of bad debt, there would be some damage to people that were overextended on their mortgage or so on, but there'd be a lot of people that didn't have any exposure. They would be fine. And so the top of the wealth power pyramid, not the bottom 95%. So that's where our political system is at risk as well, because the rich have gotten richer and they've bought the political influence, and this is causing a disintegration of the social contract and all the things we've talked about.
Well said. On a positive note, Charles, maybe like saying on a negative, before I say positive, the negative is both of these options, these tectonic forces, are going to collapse. Both of them at some point, maybe different points, will fail. That's the bad news and the obvious. The good news is it's not like the world will come to an end. It will force the changes that need to happen, and it's always a crisis that it takes to make the changes. Politicians will always go that way, and they can't do any other thing about it. I know just before we started, I was listening Trump's talking about a 20% tariff on Mexico. And what's the reaction? I'm listening to everybody on the various news channels. Well, that means tequila prices are going up and my Corona beer's more expensive. And that was the conversation I was listening to on a $50 billion problem. But that it's personal and what's it mean to them. But so it takes a crisis that forces people to have to pay more money for their Corona beer or whatever. But on a positive, what will happen is we will have a great reset. And I think I've mentioned this before. In my opinion, it was like the world froze when Apollo was on the other side, 13 was on the other side of the moon, and whether they lived. It was 2 days where the world was just frozen. We've been a number of times in history where there's been this sense. And I think the system will freeze up where it collapses, and it's too complex to suddenly do what we did in 2008 because it'll be global in size. And probably what will happen is ATMs won't work. There will be police will be involved. Martial law will be declared. But it's a period where probably, I don't know, maybe 2 weeks, 3 weeks, the world leaders are forced to meet like Bretton Woods was after the Second World War, where they went and huddled and came out with a new IMF, new World Bank. U.S. became the world's reserve currency. These were all decisions that they had to take, the Marshall Plan, to restructure the post-Second World War. This will be that squared. And out of it will come a resetting and a rebalance. The bottom line, probably the U.S. dollar is devalued by 80%, which means your cars are now $100,000, your jobs are less, shoes are $300. But that's the new reality, and nobody's going to accept it. Because if you consume more than you produce, like we do, eventually the piper comes home, right? You've got to produce more than you consume. And the winners will be those who produce more than they consume. Okay, would you agree with that as we wrap?
Absolutely. And the rules are going to change. And we've talked about this before. And so we're going to have to remain alert, flexible, and resilient because the rules are going to change and we're not going to have any control except our response to those changes.
Autonomy, out of debt, and I stress the word of being very autonomous, self-sufficiency, dealing at the community level versus the higher level, where the kinds of dependencies that we had back in the 30s, where everybody supported each other's, how they got through difficult times. Those kinds of things will be very, very much more important. And I know you've actually written on this quite a bit. Charles, any last comments before we break?
Just come visit me at of2minds.com and see what else I've written on these topics.
Well, next month we're going to have another negative subject, but and we're going to talk about, I think, our concerns that we have of what's happening in real estate, not housing, commercial real estate. What's happening, and we've talked about this extensively before, what's going on in the retail space. And we were warning 2 or 3 years ago about malls and overbuilding of retail, but some of the things that we're seeing there now. And so we got looking forward to having that. So talk to you next month.
Yes, absolutely, Gordon. Thank you very much.
Talk to you then. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.